During 2008 and the lead up to the global financial crisis, there were specific people that had huge effects on the markets. Nothing similar and at such a scale has happened since until now. The headlines always point out that the global financial crisis was between 2007 and 2008, but the signs that this could occur began way before this. The event came just 7 years after the dot-com bubble and offered little long-term relief for investors. 2008 is often said to be the worst financial crisis we have seen in decades, and it wiped out people's life savings within a very short period of time. If we look back to the 15th of September 2008, when the Lehman Brothers collapsed, you can see that people were actually predicting this for a while, but when it did actually occur, it sent shockwaves through the markets, and some people say this was the spark that ignited the fire. Years of low interest rates led to mass lending, and that created demand, so the prices of houses soared. And that lack of control around lending meant that people with low credit scores could borrow huge amounts of money from the bank. It was a recipe for disaster that was left cooking inside a pressure cooker until one of the bolts gave way. One of the issues was how the banks sold the debt to Wall Street through mortgage-backed security. Eventually, the low interest party ended, and the effects were detrimental to both the banks and their customers. So what led us to this situation? Following the dot-com bubble, the Fed lowered interest rates from 6.5% in May 2000 down to just 1% in June 2003. Many of us are well versed in what this means, but essentially lower interest rates means that it's inherently cheaper to take out mortgages or loans. But when this is mixed with poor restrictions, it's an accident waiting to happen. In 2004, the SEC gave 5 banks a wider spread for net capital requirement, and this allows them to leverage investments significantly. In 2007, the S&P 500 hit an all-time high of 1585, merely surpassing the high that it reached in the year 2000. But following the Lehman's collapse, the S&P 500 fell by 21% from its all-time high. In hindsight, the initial fears that had been circulating surrounding the possible implosion of banks after years of almost infinite money exchanging hands, met with a consistent decreasing stock market, may have been a sign that something was brewing. So in 2007, the banks were announcing losses and requiring emergency liquidity injections from the central bank. And this wasn't just within the US, that was across the globe. As the situation worsened throughout 2007, the heavy mortgage-backed securities that the banks had rolled out throughout Wall Street began to increase the pressure on the holders. To say that trillions of dollars were on the line and the US were essentially sleepwalking into the perfect storm is an understatement. In January 2008, the Fed cut interest rates by 0.75% to try and relieve some of that pressure, but as we all know, this wasn't successful. Northern Rock Bank had been bailed out by the Bank of England in 2007, but this liquidity injection was no help, and the government were backed into a corner. They chose to nationalise the bank. On top of this, a bank you may not have heard of, Bear Stearns, which was operational since 1923, collapsed, with JP Morgan acquiring the bank at a cut rates deal. These factors were all dominoes in the build-up, and it's almost like the stars aligned to create this big finale. One of the biggest Ponzi schemes ever was run by Bernie Madoff. Now, he was seen as the face of Wall Street for many years, but he actually managed to run a Ponzi scheme for a minimum of 17 years. From the sheer scale of this Ponzi scheme, it is sometimes assumed that it could have been even longer. He created this facade by offering huge amounts of reward for putting trust and funds in his care, and there wasn't much risk, supposedly. Of course, nowadays, we've seen this play out over and over again. We know how the story goes, and we don't trust situations like this. But back then, it appeared that he had a model that was impossible to replicate, and it seemed bulletproof to all market conditions. And Madoff even became the chairman of the NASDAQ in 1990. He got away with this scheme for so long that he continued to attract new investors, thus funding the revolving door of money when new investors' money would get given to those earlier investors. The most insane thing about this Ponzi scheme is how close he got to being caught multiple times. The SEC investigated him back in 1992, and the commission almost caught him a couple of times. We also had individuals writing letters to the SEC stating that it was a Ponzi scheme, but it wasn't until the financial crisis in 2008 where the Ponzi scheme blew up. The US stock market was in turmoil following the Lehman Brothers collapse. People were trying to get their money out of their investment, and by the nature of a Ponzi scheme, when too many people try and withdraw their money all at once, it's impossible to facilitate those withdrawals because there's no new investors providing money to the scheme to fund those earlier investors. So Madoff was arrested on the 11th of December 2008, and this came after he confessed to his sons that the project was actually a Ponzi scheme, something reportedly they weren't actually aware of. The actual cost for investors is unknown because we don't actually know how long he ran this scheme for. We can only go by his word for that, but it's estimated to be tens of billions of dollars. Taking a look at how gold traded throughout the financial crisis, gold began trading the year 2007 at $608, and throughout the year, it rallied up 41%. And in fact, on the week that the Lehman Brothers collapsed, gold rallied 20% as people were looking for a safe way to store their money. Unfortunately, this rally didn't last though, and gold did retrace its gains shortly after. From that same point of the Lehman Brothers collapse on the 15th of September, we saw the S&P 500 fall 30% within a couple of weeks. And for the year of 2000, the S&P fell by 37% and spent the majority of the year in a downtrend. In fact, it wasn't until March 2009 that the S&P 500 actually found its bottom, which it actually used as a spring for recovery. At the start of 2009, the S&P 500 looked like it could fall through the floor, but gold was trading at $880. By the end of the year, gold was up over 25%, and by September 2011, gold had been on a strong rally and had increased by almost 120% since the start of 2009. It's important to note that in the years following this, gold did struggle slightly and lose nearly 50% of its value, and by December 2015. And the S&P 500 did recover as well. As we said, it bottomed in March 2009, and it had a strong reversal. By the end of 2010, it had increased by 88%. And unlike gold, the S&P 500 went from strength to strength. In 2013 and 2014, it went on to create all-time high after all-time high. In fact, in 2014, it had increased over 200% since its low in 2009. Fast forwarding now to 2022, we saw probably one of the worst years cryptocurrency has ever seen, starting with UST depegging from the dollar back in May 2022, when we saw the entire Terra Luna ecosystem collapse. All of the catastrophic events that did occur in 2022 did affect those cryptocurrency investors and can be compared to what happened in 2007 and 2008. Billions of dollars were wiped out of the cryptocurrency market, and Bitcoin fell from $40,000 to $30,000. Off the back of UST's depeg, we saw other companies struggle as well because they weren't prepared to have an extreme bear market. We saw Celsius, Three Arrows Capital, BlockFi, and Voyager run into financial troubles. And finally, when we reached 2022, it seemed like those troubles could have subsided. Bitcoin was trading between the range of $18,000 and $25,000. And that is, of course, until we reached November 2022, when the very famous exchange, FTX, filed for Chapter 11 bankruptcy and paused all withdrawals. So major uncertainties around FTX began on the 6th of November 2022, when CZ, the CEO of Binance, the leading cryptocurrency exchange, announced that they were liquidating their FTT tokens. Now, CZ didn't insinuate why, but he did say it was due to recent revelations that have come to light. And this completely shook the markets. Now, SBF, the former CEO of FTX, did try and save the day by tweeting that himself and the company were excited to continue to climb together. But it didn't quite do the trick. Bitcoin fell more than 10% in just a few hours. And on the 8th of November, CZ announced that FTX has actually reached out for them and asked for financial help due to a significant liquidity crunch. But after performing due diligence, CZ and Binance declined to help, and the price of Bitcoin absolutely tanked. After days of chaos, on the 11th of November, FTX announced that they'd filed for Chapter 11 bankruptcy. Now, this was definitely worst case scenario for investors on the platform because it left huge amounts of questions around where their deposits had gone and if they were ever going to receive their funds back. And just as the dust began to settle, SBF started to tweet cryptic messages. He first tweeted number 1 and then what? And then he slowly spelt out the word happened. And as you can imagine, FTX's collapse was not the end of the domino effect. We saw a huge amount of problems continuing from this within the cryptocurrency industry, and companies like BlockFi were forced to also file for Chapter 11 bankruptcy. So FTX's collapse was one of the biggest in cryptocurrency history, and I still think that we're far from seeing the full extent of the consequences from this event. The allegations surrounding SBF, the former CEO of FTX, and other executives at the firm are similar to the Madoff scandal back in the 2000s. But obviously we can't confirm this until it's been through the court system, but I'm sure we will find out more in due time. And now we have the banking crisis of 2023. On March 10th, 2023, Silicon Valley Bank collapsed. And this was the largest bank to go bankrupt since 2008. This sent shockwaves around the stock markets and the banking system. SVB had over $100 billion in user deposits and was one of the largest banks in the US. It was reported that SVB was severely on the wrong side of the Fed rate hikes, which inevitably led to the downfall of the bank. Since then, the contagion has spread through the banking industry like wildfire. Credit Suisse was in a liquidity crisis and had to contact the Swiss National Bank for an emergency cash injection. First Republic Bank had to be put on a circuit breaker when its stock was in free fall. And the European crisis also affected Germany's biggest bank. Despite this, all officials are saying this is not 2008. And you're correct, it's not 2008. But history doesn't repeat itself, but it may rhyme. When a bank as big as SVB collapses, it's bound to have a big effect on the financial markets. The US officials are bound to try and stop us create panic. If there is panic, there could be a bank run, and that is not what we want to see. But many people are speculating whether SVB was the spark that could ignite the fire. In 2007, the S&P 500 started to decline pre-crisis. This is something we saw in 2022. So, are we in for a rough year? Let us know in the comments below. I hope you have enjoyed today's video. A lot of work has gone into this, so if you have enjoyed, please don't forget to like and subscribe and press the bell notification button so you don't miss the latest cryptocurrency